Ew. The host has unmuted my mic. Thank you very much. So now I can be heard. As you can see, I'm not in my usual studio today. I've been working so diligently. Today, I've got a due diligence seminar for my clients on Saturday, and so that's going to take up 2 hours on Saturday. Hey AJ, it's going to be Saturday 10 to 12, teaching the 3 levels of multifamily due diligence. One of my favorite topics because I use a lot of real life stories, and some are good and some kind of cause PTSD for me, but hey, somebody had to go through it, so you don't have to. All right, so we got a really interesting topic today, and I'm going to let it build up a little bit more before I post this, because I'll give you the whole story. But before I do, while we're waiting, I'll add, I will talk about the shocking news I received from my doctor this past week. I'll let you all in on. So my brother-in-law is a cardiologist and down at Beth Israel. And he said, your age, 72, your age, and, you should get a baseline CAT scan for your heart because of your family history. And, my grandfather died of heart disease at 49 years of age. My father had his first heart attack at 50. My brother had his heart attack at 51. My mother had her heart attack at 52. And then my dad ultimately passed away from heart disease, got another heart attack at age 82. So I thought, yeah, maybe I should do this. So I had to do 2 trips down to Mount Auburn Hospital for the CAT scan because they said my heart rate was too high. Well, what do you expect when you're driving down from New Hampshire to Boston at 8:00 in the morning? Yeah, you get a little excited. So I had to go do that twice. And then the second time, they're like, you gotta go to your happy place and you gotta really just kind of relax and settle down. So I was finally able to get the heart rate where it had to be. And they took pictures. They sent me on my way. And then I got a phone call from my brother-in-law the next day. He says, I got some bad news for you. I'm thinking to myself, here we go. Gonna get my chest broken open and do what is it, bypass or stents or what have you. I said, what's the problem? Go ahead and tell me. He says, your arteries are perfectly clear. I was like, okay. So what's the bad news? He goes, you're obviously adopted. Bump. So those are the jokes, folks. What do you expect? All right. So listen, here's the topic that I'm talking about today. And if you looked at the title, it was like massive passive investing or doing it the Warren Buffett way. Which one's the right way? And I use that. I hope you kind of got the joke in that I wasn't being entirely serious about, massive. All you have to do is be a passive. My second heart attack of the day. Yeah, thanks. Sure. Exactly. So I wasn't, this whole concept of passive investing, we talked about it on one of our past YouTube lives. And I talked about the Warren Buffett model and how they've got all these people out there teaching you to do passive investing, and you're just going to be, the best way to make millions in multifamily is to do passive investing. And there was just something about it that I couldn't quite put my hands on it. But after that presentation, I had a talk with my team, and they had watched it, and they said, that was really good. People were engaged. People got it. People understood that this whole concept of raising money for other people so that you can be a GP is just not the right way that you're ever going to end up owning. I don't know any multi-millionaire multifamily investors that did it that way. So what am I missing? Why are these people doing it? Why are people launching on to their stories and making it happen? And so I thought, you know what? Let's sit down and map it out. Let's actually look at the numbers. And this came about after I did Cornelius Cannon's multifamily shark room event last week. Yeah, it was last week. It was a week ago, Thursday. And they had a group on there. And when he put up the page of all the GPs who are part of this deal. So this isn't the LP side with people just putting money in. This is the full GP side. And this GP side was being split 7 ways. I thought, wow, there's not a whole lot of money in this deal if you've got to split it 7 ways. Who's making any money on that? And that should be, if you're looking to get into a particular deal and you're looking to sign on and put your money in, when you see that many GPs, that's a red flag. If this property starts to get hard to manage or doesn't look like you're going to hit the numbers you thought you were making, what's their level of commitment for staying in the deal? What's going to keep them in the deal? The other thing too is, I didn't talk about, I think I may have talked about it at one point, but that property, there's 4 properties down in Houston that got foreclosed on. And there was a little hanky-panky with the money going on, and they're looking for somebody who skipped the country. I'll tell you right now, if anyone else signed on as a GP and they signed their name as a guarantor of the bad boy provisions, it's a joint and several liability, and the last person standing is the one that is going to be the one to lose everything. So don't just sign your name on the dotted line. Get very smart about what you have going on. Okay, so let's talk about this. And what I've done is I'm going to share my screen here. Is we actually sat down and created a calculator. And so I'm going to walk you through. What I want to do is I want to put this calculator on my website so that people can look at it and test it out and see which is the right model for them. The massive passive, I got to keep in mind, the massive passive investing way or the Warren Buffett model. And here's what I ask of you. As you're on this call, chime in on the comment section. This calculator is in the beta test mode, and it might not be right. And we might be missing something. But if that's the case, let us know so that we can fix it, because I think we're onto something. So if you're right now sitting at home and maybe you're analyzing a deal that's been come across your desk, or maybe you have one that you're ready to go out there and raise money for, get it out in front of you. And then I'm going to ask at the end, give me some of your numbers so that I can plug them into the calculator and we can see if it actually works the way we think it's working, because it's pretty shocking, if you ask me, when you finally get down and look at the numbers. So I'm going to come over here. No, I'm not going to edit my name. I think I'm going to let me see. How do I do this? There we go, Molly. Thank you, Molly. Molly's got my back. Okay, so let's take a look at this. Let's say, for instance, that you, oh, wait a minute. All right, so I have to go on the screen here. Folks, this is new to me. Okay, wait a minute. Hold on. I'm going to stop the sharing and start again. Let's try it again. All right, so Molly, I'm going to go over to present, share screen. Windows right there and say share. Okay, so Molly, are you, I guess if Molly can chime in and tell me, are we looking at the Excel spreadsheet right now? And because I can't see anybody, but hold on, maybe I can, maybe what I need to do is go on to StreamYard, make sure that everybody's seeing what I'm seeing. Okay, log in. Dan, oh, wait a minute. Maybe Dan's talking to me here. Sure, I think I can come up with, okay, good. All right, that's not it. Get login code. Hold on, everybody. I appreciate your patience. I think this is going to be really cool once you see it. There we go. Where am I? I gotta go here. And we actually tested this in the rehearsal, and it sort of worked. Okay. Let me enter the studio. Number 2. Okay, so I see what you're all seeing. Okay, let's see if I can modify this. So if I click here. Oh, good. All right, excellent. Thank you, everybody. Thanks, Molly. Now I see it. I'm on. Here we go. Okay, so let's say, for instance, that we need to make $10,000 a month. For you to quit your job, you need $10,000 of income from multifamily investing. Okay? Now, what we're doing here is we're going to compare what you can expect to make as a passive investor, and I'm going to tell you what the rules are that we're using in our model, or you're going to be a Warren Buffett model where you start out small, you add to it, you don't do distributions, you don't give out dividends, you refinance the property, you sell the property. How many units do you need to own to get to $10,000 of income from passive or active? So the price per unit, what I did here is I used Cincinnati. And I said, Cincinnati, I did this research, the average price per unit in Cincinnati is $183,000. If you've chosen a particular market, put your number in here. The average rent in Cincinnati is actually $1,850 per unit per month. That's just straight up average. Now we're going to just put in a 10% vacancy factor, safe bet, because the calculation is going to need this information. We're going to use a 30% down. Now that's a 25% down with about 5% built in for like acquisition fees, closing costs, because we need that number to be accurate in order for us to determine our returns, our cash returns. The interest rate's 5. Let's do 5.25. All right, 30-year. Now, because this is on the starting small model, what you probably want to do is use a 25-year amortization instead of a 30-year amortization. A 45% expense ratio is right on the money for a B class asset. You can put in 35, 38 for an A class, 55, 60 for a C class. But let's stick with the C here. Now, the question here is, do you own your own property management company? All right. If you're going to do the Warren Buffett model, and this is going to be your job, this is what you're going to be doing for a living, you will be your own property management company. I own my own property management company because what I realized was when I was being the GP, I was essentially doing more than my property management company. I had staff on the property that I oversaw, but the regional property manager who came around every Friday afternoon to make sure everything was fine, she just showed up, and she got 5% of everything I took in. So when you start to be your own boss and you own your own properties, you're going to be your own property management company. It may take you a certain number of units before it makes sense, but we're going to tell you how many units it's going to take. Okay. So in this particular case, I'm going to say that, yes, we are our own property management company. Now, here's $1 million question. When you're going to build it on your own, are you doing it by yourself, or do you have a passive do you have partners that you're working with? I have some of my students who are really 50-50 partners, and one guy throws in 300,000, another guy throws in 300. They go out and buy a property, and they both own it together. But in this particular example, let's just say that, we're going to have two of us in there, not 20, but two of us. There are going to be two of us in our company. Don't count yourself, so it's actually going to be one. All right? Now, what happens if you have other general partners that you have to split the GP share of? Now, I'm going to shock you. That last deal I looked at, there were 7 of them. So we're going to put in 6 other partners in this deal. And now here's the other thing, and this is very important because this drives me crazy. And this is so anti-Warren Buffett. Ask yourself the question, how much does Warren Buffett distribute to his investors every year? The answer is 0. He talks about in all his years, he's only given out one distribution. One distribution. That was back in 1964. And he jokes saying he must have gone to the bathroom when that happened. And he makes a very good point when he by the mere fact that he doesn't distribute any dividends. It's because the money is better off used in his vehicle than it is back in your bank account. See, if I paid you a 9% preferred return, you get 9%. No, you get 9% less the taxes. And then you've got to do something with that money. And it might sit there and earn 4%. So that property is not really, that money is not really generating a whole lot for you. But if you understand the power of the cap rate and put this money into the property, that I'm going to put myself down here so you can all see me. And you put this into the property, then you can see with the power of the cap rate, that 9% return is paltry. Just look at it this way. With $1 increase in the net operating income, I can pay that to you as a distribution or an earnings, and you get 9 cents on that dollar. Or I can take that money, I can plow it back into the property, and on a 4 cap, I can turn that one new NOI into $25 because that's the power of the cap rate on a 4 cap. So that's what you have to think about. Warren Buffett understands it. But in this particular case, everybody that's in this bill, we're going to give you a 9% preferred return. Okay, fine. You and everyone and their brother. I don't know why. Folks, look what happens. In order for this to earn anything, if you were doing it the Warren Buffett model, you'd have to acquire 83 units and you can quit your job. If you were doing it the passive model way, you'll never get to that $10,000 number. Now, here are the things that I want you all to consider. The reason why there's no solution under the passive investor model, I wonder if Dan put it in here. As a passive investor, the economics of this investment will not work. More than likely, it's because the rental income is too low or because the preferred return is too high. This property is not generating enough of a return with a 9% preferred return first going to all the investors for the general partners to earn a dime. the passive investing model doesn't work. So if there's anybody on here that has any numbers that wants to compare it, let's say, what happens if we need $5,000 a month? We'll keep all this. Well, let's say we got a $2,000 bump up in the rents, and let's say that we'll keep that. Let's say the interest rates came down. Let's say we got to a 360. Interest rate. Oh, I did that wrong. One wrong. Let's see it. It's a 5. Oh, here we go. 5% interest rate. Oh, come on. 5. There we go. A 360, 30-year mortgage. Expense ratio is fine. Yeah, I own my own property management. I'm going to do it myself. And I'm going to have 2 other partners. Still don't make enough. Look I only need 12 units. And you might be thinking to yourself, Charlie, I can generate $5,000 a month of income with just 12 units in Cincinnati. Well, here's the real thing that you got to take into consideration is that you've got 12 units. Let's do the math here. 12 units. You got $2,000 a month of rent, 5% property management fee, times 12 units. Yeah, it's $1,200 a month you're just making from property management. So $3,800 a month you're making from the cash flow on the property. And that's how you generate $5,000. What happens? Is it going to be a direct correlation if we increase it to $10,000? Yeah, about 24. Yeah. So as you can see, you really don't have to have a big number when you start out small and build it up. That's how all of the multifamily success stories that I've ever heard, that's how they got there. And it had nothing to do with passive investing. I think it is the equivalent of multi-level marketing for multifamily investors. Only people who are making any money are the people at the top. The people at the bottom are not making a dime. And they're not telling you that because that would destroy their narrative. And I'm here to destroy their narrative. I want to see everybody be the Warren Buffetts because of multifamily. It's a lot easier to make your money that way than it is to try to put it into somebody else's deal like that. So that's, let's give you one more example. And I got to figure out how to do this. Here we go. I got to go back to this. Click here. I'm going to present, share screen, window. Okay. So let's try it one more way. Let's keep the $10,000 on there. All right. Let's keep the $183,000 a unit. Let's say the rents skyrocketed to $3,000. And we're going to put less money down. And the reason why I put less money down is, well, let's say we got we'll put 25 down. That's kind of realistic. The interest rates go back to prehistoric levels, 30-year M. Okay. And if I have, in this particular model, the Warren Buffett model, I need 10 units. Passive investor, I need 283. But the rents in Cincinnati aren't $3,000 a month. And if they were, you wouldn't be spending $183,000 a door on them. Okay? Does anybody, can somebody throw something out there that just tells me where I'm wrong? Is this, should I get this up on my website? Geez, all right. Well, I guess we're playing Stump the Professor, and that's it. We've spent countless man hours and thousands of dollars working on this model, And I think it's a story that needs to be told. It burns me up when I see these guys. And this one guy on last Thursday night's call, he's doing his pitch and he's doing his song and dance, and I mean, he's practically using that voice, the one that you hear me talk about, bring your cash in while we're slashing. I mean, he's just really doing the sales pitch. And he used to be a Marcus and Millichak broker. So that's the side of the equation that he's from. And then he makes the biggest faux pas. He just says something that he never, and I didn't say anything, and I'm looking back on it, I wish I had. He said, because we were really humming on the acquisition fee. They wanted 4 to 5% acquisition fee, which is, pigs get fat and hogs get slaughtered. That's being hoggy. That's a lot of acquisition fee. It was a big number, big price, maybe 25 million or something, and 5% of that is a lot of money. If you're dealing with a savvy Wall Street investor, they're not going to pay you a 5% acquisition fee. Not a chance. The only people who pay that kind of acquisition fees are the unsavvy investors who just want to own multifamily. But this guy said, when we were kind of harping on him about how big his acquisition fee is, that acquisition fee is how I get paid. That's how I feed my family. Oof. You should not have said that for 2 reasons. Number one, when I hear that the only way your family is going to get fed is if this deal closes, that's a level of desperation I don't want to have with my investor group. And number two is, when you put it that way, that the acquisition fee is how you earn your income, what you're doing is you're telling me that the transactional fee income is more important to you than the investment income from the property. And that tells me that our objectives are diametrically opposite. When you tell me that that's the way you're making money in this business, you are a broker and you're not an investor. So does Warren Buffett need my money to feed his family? No. And I don't want to hear that my investor partners in this particular deal, which is a suspect deal to begin with, that's how they need to make this money. Big mistake. And I didn't say anything. I felt bad for the guy. He was getting beat up, and I didn't want to jump on. I don't want to pile on. I know what most of you are thinking, Charlie. That's what you do anyway, isn't it? No, I'm a nice guy. So so that's what I got today. That's what I got today for you. I hope it was helpful. We're going to test it out a little bit more. I'm trying for somebody to tell me that doesn't work. Maybe you should do this. You didn't do this. You didn't take this into consideration. One of the things we didn't take into consideration in the equation are acquisition fee income. Okay, because you get that once and then you're done. I'm looking for income that's going to pay you month in and month out from the property. So that's why I kept it out. I just wanted to see the income, and I included the property management fee income only on the Warren Buffett model and not on the passive investing model, because you're never going to the whole point behind passive investing is you're not going to work. So, okay, Lama, good to see you. Yeah, they're not an investor. They are not an investor, and you shouldn't be putting your money with them. But I'll tell you something. That's one of the problems I see, is that so many of these multifamily deal room people, they're doing it for the income, for the acquisition fee income, which is absolutely the wrong reason to do that. So, all right, everybody, right on the money, 4:30. I hope this was helpful. Let me know how you like it. and we will chat again soon. I'm going to make sure I get out of this. There I go. And obviously you can see this on the, and this will be coming up. You'll be able to find this on our website, provided we don't find any real glitches to it. But that's kind of what I want to do. I want people to look at this and be shocked, be absolutely shocked. So, all right, folks, great to see you all. I'm going to end the broadcast, and I will chat with you all later. Thanks, everybody.